Well, I believe we are going to go ahead and get started. Welcome. As I mentioned earlier, I'm CJ Blankenship. Great to have everybody on the line/virtual meeting here as we get into our first client Zoom event under our relief consulting model of what matters most matters more. It is wild to think of this journey that we've been on over the last little bit. I'm excited to have some friends with us today. Before we get into that though, Karen, if you don't mind, would you say an opening prayer for us as we get started?
Sure. Join me in prayer, please. Heavenly Father, we want to thank you at this moment for the provisions that you have provided for us, as even the provisions that we're going to be talking about today, dear Lord, as we make attempt to run our businesses and consult with clients. We thank you for what's been revealed through this. Dear Lord, we also thank you for and ask you for continued protection for each of us, for everyone on this call, and for those extended family members and friends of everyone on this call. Just pray that you will heal and protect from this virus. And we thank you, dear Lord, for your example of leadership and how we, in the face of all the uncertainties of life, can know that you are certain. So we thank you for those things, and we ask you that we'll have open minds today to hear what's being presented and to be able to best apply it to each of our individual circumstances. We thank you again, and we ask blessings, and thank you for your son Jesus. It's through his name we pray. Amen.
Amen. Thank you so much, Karen. Excellent. Well, Nicole is going to be helping run some of the electronics today. So Nicole, if you don't mind, go ahead and let's mute everybody here, and I'll unmute myself and we'll get going. All right, wonderful. Well, I'm super excited. Again, for those who have joined some of these, our good friend and senior consultant here at the firm, Larry Klum, is going to be joining us. We've named him Triple P as the nickname there because I am telling you, it has just been spectacular having him really leading our efforts in this space. And you're going to get to hear a lot from him today over the first half of our presentation as we get into really just some amazing news. And of course, Karen Stevens, you all just heard pray, great partner here at the firm, leads our Goodlettsville office and test practice. And then my friend Paul Anglin, our tax director and partner here at the firm, is going to wrap up with a couple of thoughts around some tax credits. And most of you guys know me. So we'll get moving here. This has been, it's just amazing how we look back on the journey we've been on and foreseeing danger and taking precautions and making wise decisions. Now, as we sit with the news that we get to share today, continued efforts in this space, to say the least. But it is amazing how those who have taken good precaution, particularly in some of these different opportunities and relief provisions that have transpired, I think today what we're seeing is a lot of hope, a lot of expectations. By no means are we out of the woods. I actually was just on an economic presentation literally right before this, and it is amazing to see the charts of the level of and depth of jobless claims and the economic just collapse that's transpired. Unprecedented, nothing like this ever before, including the Great Depression, obviously not the Great Recession that we experienced. So we've got a journey ahead, but many of the things we've talked about today have provided meaningful relief in the meantime. So our hope and prayer is that we come out of this quickly. Chat rules for today. Chris Griffin, I believe, will be manning the chat. So Chris, if you don't mind, go ahead and put a chat up there for us. And if you don't mind, please refrain from answering questions. Look for answers from Karen or Larry or Paul or Chris or myself, and we'll try to get to those. If you were not on the third event, we ended up going, it was like a Gilligan's Island and the 3-hour boat tour. We just kept going and answering questions for about another 2 hours or so. We'll see what happens today, but please feel free to pop any questions you need in there as we go through. Lots of information on the website. You can request presentations and the Summation Relief Consulting Toolkit. This is our Circular 230 disclosure we're required to share. Please don't take action until you discuss your specific situation with your CPA. Do not rely on this for official tax advice or to seek relief from penalties. So that is our requirement to share. And so what are we doing today? Again, as I mentioned, this is event number 4. They're all posted on the website. You can see the link there. Objectives today, we're going to talk a little bit about, again, what matters most matters more there at the end. And excited about the PPP forgiveness process. This is a big deal. We're going to get into this right away. I do want to hit a couple of different highlights and kind of refocus around some points that are out there that's not getting a lot of press right now, particularly some that are of significant benefit to your bottom line. And so you may recognize in this blue box down here, we've talked about the PPP process and apply if qualified. We talked about 75-25, deploying to margin, liquidity, et cetera. Well, all of a sudden, Congress took some action, and it's changed a lot that we've been digging into in the PPP program, and all very pro-borrower. This is exciting news that's out there. And so HR 7010 was passed. We sent out an email, and then we punted on this 1 week so that we could join today because we didn't have any information at all. And then last Tuesday night, we received a publishing of a new application, some guidance around it in light of 7010, a new simplified application, which is really exciting. It's going to take down the preparation time in certain circumstances. And then as recently as the night of the 22nd, last Tuesday, received a lot of information that actually changed, I would say, a vast majority of this presentation. In addition to that, Larry, I'm going to go ahead and tee you up here. Welcome, my friend. Look forward to, again, chatting through all this together. It's been such a pleasure to work with you through this. But we have found out the list is being published. And Larry, we might have muted all, and so...
Can you hear me now, CJ?
We can hear you now.
Okay, great. I'll pick up the phone. Yes, for PPP borrowers who got loans of $150,000 or more, the Treasury is going to publish a list by name of those borrowers. If you happen to have a loan less than that, they're going to list those loans in aggregate by the zip code where you live. So, you know, this being an election year, we'll see how this plays out. Some of the larger loans, those are over $2 million, have already gotten some pretty negative press, and we'll see where this all leads to. But just to be aware that that's going to happen.
Yeah, that was some interesting news. There's been a lot of back and forth. Originally, Secretary Mnuchin said we did not want to share this information, and then now the pressure has come on. And so all of us recipients of PPP loans that are floating around out there, the list is being published. So just, again, all the more reason to be prudent around documentation and around a variety of issues that we're going to start getting into today. And so a couple of really big things came out of this bill. The 75 to 25% split that we've talked about around our payroll costs versus non-payroll costs. So the bill that was passed by Congress flipped this to 60-40. This is a pretty big deal, isn't it, Larry?
It really is, especially in some of the high cost areas like downtown Nashville, where rent could be a pretty substantial portion of your operating budget. This now allows for a larger portion of your PPP loan to be used for those non-payroll costs.
And we'll get into why maybe that 75-25 versus 60-40 isn't quite a big of a deal because of some of our ability to potentially extend to all the way up to 24 weeks in the bill, which is pretty spectacular. But, you know, no other big changes in this bill around our payroll costs. It's still the same things for as far as what is eligible, not only, of course, the W-2 compensation, vacation leave, all these things, unless you're already claiming credits elsewhere. Employee health insurance pro rata piece, employee retirement plans, they come on top of that. Still same limitations around owners. And we got a little bit of some clarification around the owner compensation. We'll come to that a little bit later. Non-payroll costs, no changes there. So we're excited about that. What was changed, though, was the loan terms and forgiveness for the new loans that come out, but maybe not so much for the old loans. Right, Larry?
That's right. For loans that were made after June 5th, the day the president signed the bill, the maturity date is now extended out to 5 years. If you previously had a loan, your lender has at its option can extend you to 5 years, but they don't have to. But for those newer loans, 5 years is the new maturity date.
That's right. We've been wondering for a long time, okay, when does this thing actually do? You know, we still don't officially have a due date for the loan forgiveness application, but I think we have some practicality that's come out that we have seen. We always have known that the lender has 60 days to process. Now we, though, have the idea of principal and interest commencement date for amortization has been clarified to 10 months after the last day of the covered period. And so practically speaking, really what I think we're landing at is you really want to make sure this forgiveness application is in at least or before 8 months after the last day of the covered period. Is that a pretty good summary there, Larry?
That is, CJ. So you're right. It's 10 months or whenever your lender notifies you of the forgiveness determination after you file the application. So the good news here is that we really don't have to worry about making loan payments before you submit your forgiveness application, as long as you submit your forgiveness application in a reasonably short period of time.
Absolutely, that's kind of helped out quite a bit, and it is interesting to think that a lender may take up to 60 days to process this and then reach out to the SBA, but the SBA has another 90 days on top of that to be able to review and then ultimately remit that money back to the lender that satisfies the loan obligation. That's a long time.
That is a long time. So 150 days it could take. I suspect that most lenders won't take 60 days. The SBA may take 90 days. At the end of the SBA review time, that's the moment when the SBA will remit the forgiven amount to your lender along with the accrued interest. And then the lender will turn around and notify you that the forgiveness has occurred. If you have a balance remaining, at that time you'd have to start making principal and interest payments.
Absolutely, and I think this issue has become much less of a question because of the covered period changes. This was the biggest aspect of this bill, I think, by far, was the addition of first a 24-week period. And for a while there, we thought, well, really until 2 days ago, all the guidance pointed to an 8-week period or this new extended 24-week period, and the ability for a borrower to choose between the 8-week or 24-week period. But there was no guidance and no indication even that you could choose anything in between. But then late Tuesday night, Larry, the bomb dropped, right?
Yeah, this was one sentence in a regulation which said that once you got to the point where you had expended enough PPP loan proceeds on qualifying costs, you could go ahead and file your application. Prior to that, we were really worried that using the 24-week period, most borrowers' covered period was then going to end in October, which led us to thinking you could not file until January because you have to file, along with your application, a copy of your Form 941 quarterly payroll tax return for each quarter that overlaps your covered period. So this was a nice add-on. If you got your loan in April and you get to the middle of July and you've already incurred more than your loan amount in qualified costs, you can go ahead and apply for your forgiveness as early as October. Again, you're going to have to wait till you file your third quarter 941, but you can file now in October rather than waiting till January. If you happen to be fortunate enough that you incurred adequate costs by the end of June, you can go ahead and file in July because then you'll only be required to submit your second quarter 941.
And the really nice part about this too, with this ability to kind of pick a period, so to speak, as we'll start kind of coining it throughout the course of this presentation, is in the example you just had, someone has exhausted the full expenditures maybe by the middle or later portion of June. They don't have to wait. And so let's say their 8-week period maybe ended more in the beginning of the first half of June. They were in that first batch of loans that were approved and funded. Now they can not only, once they've achieved that full forgiveness, go ahead and get the whole process done and maybe pick a 9, a 10, 11, or 12-week period to be able to include in the application.
That's right. You know, the significance of the 24-week period is that it just expanded so many, you know, the amount of qualified costs that you have for forgiveness has tripled. If you all remember that when we first applied for the PPP loan, that was based on 2.5 months of your 2019 average payroll cost, or roughly 21% of a year. 24 weeks is 46% of a year. So this really put us to a point where nearly every borrower is going to be eligible and qualify for 100% forgiveness. So the flexibility and the lengthening of the covered period really were tremendous benefits to borrowers.
it was just spectacular. The wildest part about this is most of the first batch, so really half of the loan amounts that transpired, their loans were already coming to that 8-week period by the time that Congress passed the bill to change it. And so a lot of planning, a lot of effort, a lot of energy by many people to make sure that they were getting closer to that 100% forgiveness. Well, what this does is this adds on top, and us, we were doing a lot of planning with clients around that, obviously, Larry. And so as we now fast forward, the good news is those that were kind of marginally getting to 90, 95, or even 100% just barely, now the good news is we can still be able to file, get 100% with some cushion. But if we are choosing this sort of pick your period between the 8 and the 24 week, we've got an interesting piece. That one sentence changes everything. Not only does it create the ability to do this, but there's some little nuanced questions that are coming on around what happens if you're in this in-between period between the 8 and 24. Now, one thing we know for sure is that if we have wage reductions, we've talked a lot about what wage reductions are, and it's in our former blueprint. If you haven't seen it, when you go back and check that out, we'll talk more extensively. We'll briefly hit on it today. But if you're in this in-between period, you have to use the full wage reduction for the full 24 weeks, as the way the application reads right now, right, Larry?
That's right. So if you choose the 24-week period, but you go ahead and file early, let's say you file after 12 weeks, but you have reduced the wages of some of your employees, you're going to have to calculate the wage reduction for the full 24-week period. Now, you can avoid that by using the 8 weeks, but then, of course, you're only going to be able to include 8 weeks of qualifying cost. I will say that this is rather a rare occurrence. As I've spoken to clients, we don't often see that hourly wages were cut or that salaries were cut. Most commonly what we hear back is that we had to put some employees on furlough, but if an employee was making $25 an hour, when we ask the employee to come back, we're still paying that employee $25 an hour. It's
That's
only
right,
the case
right.
where you actually cut that employee's hourly wage by more than 25%.
That's right. And I think for the most part, it seems like it is the full-time employees equivalent numbers that we're seeing the reductions in, and less so the wages.
Correct. And of course, we got some relief in the bill and the guidance for the full-time equivalent employee test, which was really very welcome.
Absolutely. And we're getting ready to hit into that in a moment here. Maybe before we jump to this new safe harbor that came out around full-time employees, the compensation limits, because of the 8 and the 24 weeks, we've got some changes in these numbers and in the owner maximum compensation. That was an interesting twist, a logical twist when you think about it, but a lot of people, I think, started believing that, hey, if we go to a 24-week period, owner employees, self-employed individuals are going to get a much bigger number, but still limited, right, Larry?
It is, and we were a little bit surprised by that. With the original 8-week period, the $15,385, which is 8/52 of 100,000, was the cap for payroll costs for both employees and owners. So when Congress extended the period to 24 weeks, we initially thought that, well, everyone is going to have a new cap of $46,154, which is 24/52 of 100,000. But when the guidance came out last week, it did in fact say that for non-owner employees, the 24-week cap was going to be $46,154. But for owner employees, it was going to be limited to the lesser of 2.5/12 of your 2019 compensation, or $20,833, of course, never to exceed what you're actually paid. So we now have 3 categories instead of, or 3 potential caps instead of 1.
That's exactly right. And it'll be interesting, too, to see what transpires with folks that pick this period between the 8 and the 24 that maybe has not quite gotten to the full 20,833. We don't know if there's going to be a pro rata rule that comes into play. We're hoping not. We're thinking not, which is to say that if you picked a 9-week period, for instance, and by the end of that 9-week period, you'd paid the 20,833. The thought is, well, would that be limited to 9/52? Or does it go ahead and get to the full 20,833, particularly for the owners, or the 46,154 for employees? Interesting to see what's going to happen with that, right, Larry?
Yeah, they haven't given us specific guidance on that. So, you certainly could take the position that if you've dispersed to your owner employee 20,833, even though it's only, 9, 10, 12 weeks, you can go ahead and take the full amount. I would think that that's the result, but it's certainly possible that they could come out and say, no, it's limited to, the pro rata amount when you choose to file.
Mm-hmm. And same issue with employees, maybe in that interim period as well. So hopefully it's going to be just the flat dollar amount. And because those numbers are so big, where this really comes into play and is of the greatest benefit is for our clients and friends who maybe have restaurants that have really struggled to get back up or stayed closed through that period, hospitality industry, hotels, etc. Those are the ones that I think are really going to need this longest period in comparison with a lot of PPP recipients who definitely hurt through this period, but have kind of come back a little bit stronger.
Yeah, if you've brought your employees back even after the initial shutdown, given the 24-week period now, it's very probable that you're going to incur costs far in excess of your PPP loan. But if you continue to be subject to restrictions and a portion of your operations is closed and not all of your staff has been able to return to work, it is possible that you're not going to be able to get over that threshold. But certainly the 24-week period is going to help.
Absolutely. And with that, this is probably, aside from the 24-week change, which was just huge, is this new safe harbor that was introduced inside of, and kind of finds its way into the easy application as well. But we're going to talk about the 2 safe harbors that were previously in place after this around wages and full-time employees. But this new safe harbor, this is a pretty big deal, isn't it, Larry?
Yeah, this was really a very significant benefit that was included in the recently enacted bill. And what this did is it eliminates your requirement to go through these very detailed and complex full-time equivalent employee calculations and gives you a pass if you meet this rule. And what the rule basically says is that if you were unable to operate between February 15th and the end of your covered period as a result of compliance with guidance or requirements issued by Health and Human Services, CDC, or OSHA, then you're deemed to have met the requirement, and you can just check a box and skip all of the FTE calculations. This is very nice. Now, it's very, very important that as you look at this and say, well, I certainly can take advantage of this. My business, I had to close because of guidance from CDC. It's very important that you document why your business had to close or why you had a reduction in business activity as a result of one of these requirements. Now, one of the nice things that the SBA did after the bill was enacted is they came out and specifically stated that indirect requirements also were going to qualify. So you might have the question, well, I wasn't specifically under the regulatory guidance of the CDC, but Davidson County took into consideration the guidance from the CDC, and as a result of that, issued the stay-at-home order. That will qualify. So if your state or local government issued a closure order, restriction order as a result of this guidance, you'll be able to qualify under this rule if, of course, your business was impacted.
Some of the important things around this new safe harbor, Larry, are the requirement to be able to certify and then, of course, to document as well. And so maybe that certification process, that same level of business activity, we've been talking about this. We think that folks that have, for the most part, either made the same or more money during this period, it's going to be a pretty hard argument to say you were unable to operate at the same level of business activity.
Yeah, that started. A number of borrowers nationally are starting to attract a lot of attention from our elected officials if they have not had a decline in revenues during this period. And you can think of a number of different businesses that actually have benefited from the COVID crisis. So it really comes back to what's the definition of unable to operate at the same level? Does that mean I have to demonstrate that I had a decline in revenue? How about if I was able to reduce my employees in order to meet social distancing requirements, but even with fewer employees, I was able to generate the same amount of revenue. Do I still qualify? That's a little bit of a gray area.
Mm-hmm. That's exactly right. And at the core of it is the requirement to document real time. So it's important to make sure that if you're going to go into this safe harbor, the new safe harbor, then it is the borrower's responsibility to be able to prove they were unable to operate at the same level of business activity, but then also to directly link that to the guidance that was issued. And specifically, we've been informed that you have to actually retain that and make sure you have both those pieces of information with a clear linkage between them, and to retain that for 6 years.
Right. All the documentation for your forgiveness has to be retained for a period of 6 years after your forgiveness determination is made. And this is one of those critical documents that you'll want to retain. A memorandum to the file, pointing to the regulatory guidance that you receive. Maybe it's the Davidson County stay-at-home order. You want to retain that and have that available if you happen to be audited by the SBA.
That's right. And some of the guidance that used to be really pretty easy to get your hands on that was floating around is a little bit harder to find now, especially real-time dated, because again, all this stuff is retrospective in view. And so, if we made a decision in April to shut down, just like, we did, other folks did as well, we need to make sure we have that guidance that was in place at that time that resulted in that decision. And then, of course, then be able to link it up with the business activity. Don't want to be looking for this when somebody comes and asks for it. We need to look for it now.
Yeah, it's already gotten a little difficult to obtain. If you go to the government agencies, the CDC, for example, and look at their webpage, what they're now showing on their webpage is reopening guidance. And some of the guidance that they had outstanding back in March is very, very difficult to find and download. So if you've got that in your file, you want to make sure you retain that and have it available.
That's right. Go find it and use it. And so the other safe harbors that were already in existence, really the big change that transpired here is the restoration date, right, Larry?
Right. So this safe harbor, in the legislation that was passed on June 6th, it extended the safe harbor date from June 30th to December 31st. Well, that was nice, except if you happen to be a borrower who wants to file in July, how do you handle the December 31st date? So what the SBA did is said, your safe harbor date will be the earlier of December 31st or the date you apply. So for both of these safe harbors, what has to have occurred for the FTE safe harbor, for example, you had to experience a reduction in the number of full-time equivalent employees between February 15th and April 26th. And then by the safe harbor date, the date you file, or if later, December 31st, you have to restore the same number of FTEs to your business. And then the same safe harbor with respect to the salary reduction. Again, we don't see this very often, but if you happen to have reduced the wages of your employees as a result between February 15th and April 26th, as long as you restore that hourly rate or that salary by the date you file or December 31st, you'll meet that safe harbor. And these two safe harbors are applied on an employee by an employee basis.
That's exactly right. So that was a nice piece of information. The bill itself, 7010, the new bill from June 6th, specifically stated this new date of 12/31. And so there was a lot of question on, well, what happens if you file earlier? What happens? Can I get something better? And so by putting that application filing date in place, it really has simplified this and sped up our ability to make decisions around it and actually perform the filings themselves. So with that, these three things that we just worked through, this new FTE Safe Harbor 1 and the old two safe harbors, these were really important when we were finding ourselves in the reduction phase. Now, the good news is, and a lot of folks are in there, but the good news is that the SBA has come out with a new 3508, that's the application forgiveness request form, EZ, which simplifies it. And when you look at it, it is super duper easy compared to the other one. But at the core of it, a lot of the same, you still actually have to have all the same underlying documentation, which we'll talk about here in a second. But if we can get into the EZ filing, it's going to be a lot less cumbersome for the client, It's going to be a lot less cumbersome, and in many circumstances, especially for the folks that fall in the first assertion, potentially can tackle some of that in a very easy, uniform format, not a lot of work at all. The other two still going to need some pretty significant documentation potentially, but it's going to be much less time intensive. And so what are these three assertions, these three data, and you got to be able to check one of the three. So Larry, why don't you talk us through either one of these three doors to be able to get into the form?
Sure, and again, as CJ mentioned, you only have to meet one of them and you qualify, and then you can avoid all the detailed calculations regarding your full-time equivalent employees. The first one's pretty easy. If you're a self-employed individual without employees, you qualify. The second one is, for both the second and the third one, you have to meet one condition in each, and that is you cannot have the 25% wage reduction for any of your employees. As I mentioned earlier, that's relatively rare. We haven't seen that too frequently amongst our clients. Now, for the number two set of criteria, the second reduction is you cannot have had any reduction in full-time equivalent employees, so no reduction in employees and no reduction in paid hours between January 1st and the end of your covered period. So those are for companies, you never laid anybody off, you never cut hours, and you never cut anybody's wages. You're going to qualify for this. Now, we put in the parenthetical here that if you happen to be a partnership without employees, you're always going to meet this requirement. The third set of criteria takes into account that new Safe Harbor 2, which we talked about earlier. So you haven't reduced your employees' wages by 25%, and you meet that requirement where you were unable to operate at the same level as you'd had on February 15th due to your compliance with COVID. If you can meet those two requirements, you can file the Form easy and avoid the FTE calculations.
And that makes a big difference. You know, at the core of it, though, and this is one of the things that I think is really important to understand. So that second one, not a lot of clients with employees are going to have absolutely, no reductions in average paid hours or reduction in compensation, because this isn't the 25% wage reduction. It is just the flat full-time equivalent reduction, right, Larry?
Well, you cannot have had the 25% wage reduction, but here you just cannot have reduction in the number of employees or paid hours.
Right.
So yes, you have to assert, from January 1st until the time you file, that you've not had a reduction.
Absolutely.
Now, some employers will qualify.
That's right. I think the third door is the one where we're going to see the most opportunity for clients to be able to walk through, of course, unless you fall into, number one or number two with no employees. That's just where this assertion around operations, same level of business, really becomes very important. But in all of these, it's very important that we make sure we think about the documents that are required to be maintained, because we have to, if we make these assertions around wage reductions, we make these assertions around the retaining of number of employees. It's very clear in the instructions to the easy form, all that information must be accumulated, processed, and be able to prove that. So the individual payroll records, the 2019 payroll records as well, obviously the payroll records during the covered period, and as of 1/1/20 and then 2/15/20. So all that detail is still very important to make sure that we keep a hold of, right, Larry?
That's right. And at the end of the day, at the core, we still have to document and show that we've got qualified expenses in excess, well, two things, in excess of our loan amount, and that our payroll costs exceed 60%, equal or exceed 60% of our loan. We need those two things to get forgiveness, even if we file the Form 3508EZ.
Absolutely. So with that, I'm going to go ahead and move here, and I'll zoom in a moment here, but this will look a little familiar to you. This is our loan forgiveness blueprint. We've updated it for this wonderful concept called the easy bypass. I can't help every time I see that but smile and think about a toll road and, the benefit of going around a city and getting around maybe a big construction zone that we're seeing on the in the modern day, the Google Maps and so forth. And so that easy bypass is nice because it gets us around the wage reduction calculations. It gets us around the full-time employee reduction factor. These are really, you know, cumbersome processes to work through. So if we can get through the easy, that's great. A lot of clients aren't going to be able to. Some clients are not going to be able to. And for those that aren't, that's all right. Still work through the process just like we have. And now because of that 24-week period and the ability to pick your period, it's going to be much easier, really almost a given to be able to get to 100% forgiveness. Still have to do all the math, still have to be very intentional about making sure to select the correct period. But as we work through that, now you'll see this new 60% piece that's been brought into play around the breakdown between both the payroll and the non-payroll costs. Still have the reduction. If you get the easy bypass, you don't have the reduction factors, just get to your modified total. And maybe this is a good place, Larry, for us to talk a little bit here about the desire to be able to make sure this modified total that we arrive at is going to be a lot bigger, or at least somewhat larger, than the actual loan amount itself. I mean, I think that's one of the big takeaways with this extended period.
Yeah, I think it's to any borrower's advantage when you go ahead and file your forgiveness application. You want to do so after you've incurred more than, perhaps significantly more than, your loan amount. Your forgiveness is going to be the least of these three numbers: 60% of your payroll costs, your modified total, which is the sum of all of your costs less the reductions, and your loan amount. You can never get more forgiveness than your loan amount. So let's say, for example, you had a loan amount of $100,000. There's nothing to preclude you from. In fact, we recommend that if you filed your application showing qualified cost of $150,000, you're going to get full forgiveness. You then have protected yourself somewhat that if for whatever reason the SBA were to come back and say, well, you really are subject to some of these wage reductions or the full-time equivalent employee reductions, you have $50,000 of cushion before you get to the point where you're not achieving 100% forgiveness. So I would recommend not to go ahead and file your application the moment you get to your loan amount. Accrue some expenses and pay some expenses in excess of your loan amount before you go ahead and file. You have 24 weeks.
Absolutely, Larry. And because now these numbers are able to be so much larger, I really think it makes sense to put that cushion in place so that if something were to transpire, particularly if you were relying on one of the safe harbors, something were to come up to where that reliance on the safe harbor maybe was called into question, in the application of particularly the FTE reduction factor, which is what we're seeing as the most likely reduction that comes into play, it would really be as my oldest brother Trace would say, that'd be a real bummer, CJ. He's a great attorney here in town. Maybe he's on here right now, but I've heard him say in a lot of, now that would be just a real bummer. And he does, we'll be on an M&A call and talking through these things. And it would be a real bummer if we were to be at that $100,000 loan amount, hit the total maybe of 100, 105, 110, go ahead and file that application, rely on a safe harbor to get out of it, and then something were to, transfer, oh, forgot about that employee, or oh, we missed, can't really rely on that safe harbor, and all of a sudden a reduction factor comes in this really compressed period that maybe results in a 30 or 40 in that example 1,000 reduction, and all of a sudden now we're not having that full loan amount forgiven because of the fact that we potentially are not seeing any language around the ability to amend a return at this point, right, Larry?
Right. We haven't seen where we could amend the return, or if that you're audited and some reduction is sought by the SBA, that they wouldn't at the same time, you could come back and say, well, but I had these extra costs that I incurred, in the 5 weeks afterwards that I could have used. We don't know how that's going to play out. One of the things we didn't chat about is some gray area with respect to the new safe harbor is a tangentially condition that affects your ability to operate. So let me give you the example. In the regulations, the SBA talks about a beauty supply company that sells both online and has a physical store. And the local government has ordered the store to close because of social distancing. Well, the SBA says clearly in that case, the store qualifies for having had its operations reduced after February 15th. Well, they didn't give us an example that I would have loved to have seen. What happens if the beauty supply company did not have a store? that it sold direct to consumers, but also sold direct to beauty salons. And the beauty salons had to close due to government order. Does our online seller of beauty supplies qualify for the safe harbor? I think it probably does, but it wouldn't shock me if the SBA came back and said, no, it's not directly covered by that local government order to shut. Only the beauty shops it sells to is. So again, it kind of comes back to this idea of put a little cushion in your numbers so that if we have a disagreement about whether the safe harbor does or does not apply, you've got some room to take some reductions and still get 100% forgiveness.
Absolutely. We have clients that fall in that exact scenario that you just talked about, Larry, where maybe they're a wholesaler and the folks that they sell to are all shut down. So their supply their sales dried up. And we have lots of folks in that scenario. And so it'll be interesting to see what that tangential effect plays out at, as well as the same, the proof around the same level of business activity. How is this 850 seconds to 2.5/12 for owner compensation going to play out? If you pick a period that's less than the full 24 weeks. We got some great guidance literally right before this presentation about the 3 different categories, more or less, for owner employees versus self-employed. We're not going to really get into all those details, and so we got to strike through that one. That was really nice to get that information. But in that place, I think it's important maybe we share, in these developments around the uncertainty, this Amazon, delivery story that's popping up right now, Larry. This is a great example of the political nature and the scrutiny that's starting to transpire around, especially once the list gets published, around the PPP.
Yeah, it was interesting that this article appeared in the Wall Street Journal earlier this week about a company down in Jupiter, Florida, and they're engaged in the business of providing last mile delivery service to Amazon. Amazon's their principal customer. And this company actually has experienced a substantial increase in revenues during the COVID crisis, and they had applied for and received a $3.4 million PPP loan. Now they applied on April 8th. And so, as you look at that representation about the economic uncertainty and how that would affect your business, you really have to put yourself into the mind of the applicant. When they applied back on April 8th, this particular company filed its 2019 annual report on May 29th. So about 6 weeks later. And in that report, it said the COVID epidemic had minimal effect on our results of operation. So if you happen to be a borrower that has a loan in excess of $2 million, remember, if your loan amount is less than $2 million, the SBA granted you a safe harbor that said, we are going to assume that you met the economic uncertainty test. No need to worry about that. You've got a safe harbor. But if your loan amount is more than $2 million, you do have to worry about the SBA coming back and saying, well, your business really wasn't impacted. You did not have economic uncertainty, and that representation was not accurate. And unfortunately, that is an all or nothing decision. If the SBA determines that you did not meet the criteria, you will get no forgiveness at all. You're obligated to repay the entire loan. So our recommendation there is document as well as you possibly can those circumstances, what you were thinking when you applied for the loan, why the representation was accurate, get as much information as you can, what was happening with your business, why were you fearful of the economy at that time? Because in hindsight, if things worked out for you, that wasn't particularly known back in early April.
Absolutely, Larry. And, we're getting a little tight on time, so I'll just hit a highlight here around this little $10,000 issue. A lot of our clients received the EIDL $10,000 grant. So we're going to have a lot of these little $10,000 loans floating around that are out there. They're going to need to be amortized. And so I think as we start filing applications and getting forgiveness, I think the practical thing in many cases is going to be just to go ahead and write that $10,000 check if you have the money. Otherwise, you're going to have this little $10,000 loan that's going to be amortizing out there for a while, and some folks may need that. That's okay, but that's that reduction that's out there. And then the other big piece that's out here right now, this is significant. So I just want to take a moment and stress this for everyone on the line. right now, the IRS has issued the notice. We've talked about this before, but all the associated expenditures that gave rise to the forgiveness amount are currently non-deductible. And so somebody has a $500,000 PPP loan they're anticipating forgiveness on, depending on the state and where they're at, as much as half of that could be due in taxes, so $250,000, even though the forgiveness itself is not taxable, those expenditures are not deductible. And so, barring some guidance, Grassley specifically said, Senator, that that was not the intent of Congress, but nothing's happened, right, Larry? Here we sit, and as of now, pretty significant tax consequences from the PPP.
That's right. Now, as you mentioned, CJ, there was some congressional pushback on this, and fortunately, it's bipartisan. There was a letter sent from the Senate Finance Committee on May 5th, signed by both Senator Grassley and Senator Wyden, who's the senior minority member of the committee, saying this is not what we intended. And then they also proposed the Small Business Expense Protection Act. Hasn't been passed yet. But hopefully it will be passed, and what that says is the forgiveness amount, your loan amount is going to be forgiven, and you do not have to reduce your deduction for the amounts that you expended using the PPP loan proceeds. So hopefully we get that relief.
Yeah, that will be a very, very big deal for a lot of folks. Otherwise, I need to be considering this in the current year estimates, particularly for folks that are not in the safe harbor situation for estimated tax payments. And so with that, we've talked a little bit about perspectives around PPP throughout the course of our time thus far. You can pick 8 to 24 weeks with anything in between. That is just a huge development in the literally last 2 days. So that changes everything for when we can file and how much to file. The liquidity forgiveness spectrum that we've talked about over the course of the last couple months, we've now moved to where really from rare forgiveness to pretty much assumed. And so we're going to see, preferably with all of our clients, 100% forgiveness, and that's going to be the goal, not only but a very practical, easy goal to get to. At the same time, we do want to be really careful and make sure we have some cushion in there as we're filing those. If you've got uncertainty around any of these certifications, it's our view that we want to file the full form. And then, of course, if you're even in the full form perspective and you are having still continued uncertainty around the safe harbors, don't take them. Go ahead and take the reduction, pick the extended period, and then make sure that we've got more than enough expenses to substantiate the 100% forgiveness. Again, the good news is now with this 8 or 24 or anything in between, we have the ability to go ahead and file quickly, which is nice. So looking forward to getting these applications filed, and go ahead and close the chapter for our clients. This last piece, knowing is only half the battle. At the end of the day, it's really important to know, you can say, yes, I know I didn't reduce my compensation by 25%, or yes, I know I didn't let go of any of our team members through the course. I didn't cut any of these hours. But knowing is only half the battle. You actually have to prove it. And so having these records, very, very important. Obviously, when we work with our clients, we're going to not only obtain those records, but we're going to retain them as well on our servers here. And so just know that that is something that's out there we need to make sure we keep our eyes on. And then, of course, as Larry talked about earlier, this $2 million plus loans and the need for contemporaneous, substantial documentation and accuracy around these applications is more imperative than ever, especially given the publication of the list. And so with that, I want to kind of move towards the second part of our program here and go ahead and hand it off to Karen Stevens, who is going to run through 3 conceptual frameworks. But this is one that's out here that has kind of been quiet, and all of a sudden I think we've got some movement in it. And it's interesting. It's almost like you just have to sit and wait for your mailbox money to show up, right, Karen?
Grocery money, that's right. So the Tennessee Business Relief Program released in the last couple of weeks. The state website that explains this program, which is ever being updated, is there at the bottom in link form. And they've done a really nice job explaining the program, very easy to understand language. So basically, as that title at the top says, don't leave it all up to the feds. This is state money, which is federal money passing through to the states, but $200 million is what's been appropriated under the governor's new Tennessee Business Relief Program, and it's anticipated that approximately 28,000 small businesses in Tennessee are going to be recipients of this. So the purpose of it is to try and reimburse small businesses that have had costs directly related to mandatory closures. It's for entities that have less than 10 million in gross sales on an annual basis. So it really is focusing on more small businesses. And then how the amount is going to be awarded is going to be determined based on each individual business's sales or business tax returns. So we're still awaiting some final guidance for the determination of the amounts. But the nice thing is that each individual that's going to be receiving these amounts doesn't have to do anything other than already be registered with the Department of Revenue for either sales tax or business tax. And what the state's going to do is calculate the amounts, and they are going to direct deposit those amounts into the bank account that is already on file. So I would caution, make sure that if you are a small business and you are registered on TNTAP for sales or business tax, that you have your current and accurate bank account information updated on there. Who's going to benefit from this? If we can go to the next slide. There are really two categories. The first section are all of the small businesses that are eligible. And so as you look at that list, a lot of those, especially for those of us who are in Davidson County, are really those businesses that have been even into phase 2, 3, and beyond are still being affected. And so barber and beauty shops, amusement, and performing arts. And then in addition to those small businesses, the following small businesses that are listed in that second section, if they can substantiate that their sales were reduced by at least 25%, again, as going to be determined on their April sales tax returns filed in May. So for those returns that were already filed, a bookstore that has a sales reduction of at least 25%, they're also going to receive those funds. And again, they'll be direct deposited. So small businesses, gross sales of less than 10 million. All right, that's just a high level on that. And then a couple of reminders, and I will say we went into a little bit more in depth into the HUD during our one of our previous webinars, and I think that's on the next slide. So if we don't give you enough information on this, you may want to go back and re-listen to that part of a previous slide. But for HUD, we've got another extension from June 30th to August 31st of the eviction and foreclosure moratoriums. And, you know, we talked in our previous session about how many rental properties there are in the United States and how many might be financed with some type of government-backed program. So essentially what this is saying is that for HUD multifamily properties, they've extended those forbearance deadlines. And for properties that are not multifamily but are only 1 to 4 family, so maybe single family dwellings where the mortgage is some type of government Fannie or Freddie Mae, those extensions have been extended as well. So just keep in mind there's two things here. There's forbearance, meaning the payments could either be suspended or halted and then tacked on at the end. And then there's also, as it says here, an often overlooked significant provision. During this period of time for those 1 to 4 family dwellings, you cannot initiate any legal action or charge any fees or penalties for non-payment. So it's a double-edged sword. Keep in mind, if you are the person owning the property and renting to others, you've got to follow all those rules for your tenants. And if you are on the tenant side of things, you've got to make sure that the mortgagor, who your lease agreement is with, is following those provisions as well. I think that covers most everything on that slide. And then a couple of other items about the rest of the CARES Act, and it says there at the bottom, refer to the not-for-profit and governmental relief event for a little bit more information on this. But as part of the CARES Act, there was this $150 billion with a B fund, relief fund, and those funds are being divided up by state based on population. That's part of where that funding for the Tennessee Small Business Relief Program is coming from. It's also meant to provide for public health, all of the expenditures that were incurred, particularly in March, April, and still continue today to some lesser extent for all of those direct COVID-related expenses. And then miscellaneous provisions include things like replenishing of supplies for public safety and public health, including firefighters, police, that type thing. And then there's $100 billion for lost revenues for healthcare, those qualifying healthcare institutions, and another $30 billion for the Education Stabilization Fund, which will come to educational institutions, both private and public, that were affected by all of the closures, having to go online, and the expenditures that they occurred in relation to that, as well as the loan programs for individuals who are receiving grants for tuition. So lots of information in there. Some of that money's been expended, some of it is yet to come. And so if this applies to you, keep watching the websites for each of the various governmental agencies that you work through. And as that information becomes available, we'll share that with you as well. So.
Absolutely. Thank you so much, Karen. Great job as always. And, you know, it's just, I think it is easy to overlook how much assistance has been given out there. You know, I logged on and looked at the debt clock the other day for the U.S. So when this started, it was right around 20 trillion, which is a big number. And then logged on and looked at it the other day, and it was 26 trillion and counting. And so we have, there is a absolutely huge amount of money that is floating around out there for eligible recipients. You know, whether you're an education institution, you're a healthcare institution, a variety of other organizations, it's important to understand that it's out there and then get in line for it. And then also to understand, particularly as Karen was mentioning earlier, this ability for deferrals that's out there is really significant for those people that are hurting. And then a lot of folks I've heard tell of folks not paying rent and getting evicted, and most likely probably shouldn't be doing that, should we, Karen?
Should not be doing that, absolutely. And there was a point that you just brought up. For those of you who may still be needing some cash flow relief and you owe one of these mortgages, take a look at and talk with your lender about those forbearance opportunities. They're very specific. They depend on the type of loan that you have, but they could extend loan payments for up to a period of even 40 years. And so there could be some real relief out there. You just have to talk through each of your specific situations.
Absolutely. Thank you so much, Karen. And with that, I'm going to hand over the guidance to two great opportunities that are out there. Well, I'm going to say that one's great. The other one is questionable. And so, Paul Anglin, if you don't mind, my friend, why don't you start with our questionable, proceed with extreme caution header here.
Sure, absolutely, CJ. So nothing new per se on these next two slides, as CJ just deferred to. So the CARES Act had a payroll tax deferral that we've discussed in our previous discussions, seminars. But what changed with the Flexibility Act, with the 24-week extension, and specifically, this was not eligible to those that received forgiveness from a PPP loan. So probably a lot of people were sleeping through the prior slide presentations thinking, hey, I'm going to get forgiveness. So now with the new provisions on the Flexibility Act, this may be something that companies are also interested in. So just to remind everyone, what these provisions do is allow employer side of the payroll taxes to be deferred. So anything that would be due or incurred from March 26th to the end of this year, you can make that in two payments in December of 2021 and then the other payment in December of 2022. A nice little deferral if you need cash flow. Just be very, very cautious here. You have to make those payments. If you make those deferred payments in 2021 and 2022, they're considered timely filed, so there's no payment or penalty for late payment. If you happen to miss those dates, we're talking bad news. That would be very, very bad. I'm thinking of CJ's comment here from his brother, but this would be very, very bad. So don't find yourself in this position. So if this is something that you want to do, it's definitely there and available, but we definitely advise extreme caution around this area. You have to make those payments. So if you feel like you're in a desperate need for cash, but you feel like that's going to turn around in the next few months, weeks, maybe something to think about. Don't deplete your cash and then not have that to make those payments at that time. That would be very bad. So again, just something to look at there. The other item that we've talked about is the employee retention tax credit. If you want more details on this, obviously refer back to one of our previous client presentations. But again, This is for those that are not receiving the SBA small business loan, PPP loan. There's a credit of up to $5,000 per employee, depending on the size of your company. A lot of provisions around those. So if it's something you're interested in, please let us know and we can help walk through those calculations with you.
Absolutely. This is really the best retention prize that's out there, or really consolation prize that's out there for retaining employees, folks that have been really hurt and for whatever reason did not either choose to or were not eligible for a PPP loan. And something that needs to be thought about, studied, and then go ahead and be processed appropriately. Right, Paul? Absolutely.
Maybe just one point there, some interesting news that came out. If you happen to return your PPP loan, so you applied for, received, and then returned, this credit would be eligible. So that has been clarified in the last few weeks.
Yep, that's exactly right. Absolutely. That was good news that came out to say, hey, you know, for whatever, or if someone chose to at this point. That was specifically tied to the safe harbor date. And so as of right now, that's the guidance. We'll see what happens if, especially with the list being published, if people start making some different decisions. All right, well, with that, Larry, I guess this will be your coup d'etat. If you don't mind, close us out here with some thoughts around the Main Street Lending Program for those folks that still need some help out there.
Sure. So this is another program that's still available. It's being made available through the Federal Reserve and your lender, so your bank, if your bank chooses to participate. Now, this program was really initially designed for those borrowers who were kind of in between. They were not so large as to be publicly traded and get the large grants the government was awarding, but yet they were too large to participate in the PPP. However, even if you got a PPP loan, you're still eligible for this program. So the way this works is you would go to your local bank, request one of these loans. The bank is going to end up selling 95% of this loan to a special purpose vehicle that the Federal Reserve has set up. Your bank will retain 5% of the loan. The loan is a 5-year loan where no payments are due for the first year, interest-only payments in year 2, and then principal and interest payments in years 3, 4, and then there's a balloon payment in year 5. The rate is 1 month or 3-month LIBOR plus 3%. And if you do take one of these loans, you're going to be subject to the restrictions on executive compensation, stock repurchase, and dividends until you repay that loan. This program is only going to be available through the end of September. And then also the Federal Reserve just announced actually in a comment period where this program is going to be extended to non-for-profit organizations. There's a fairly lengthy list of restrictions or requirements for nonprofits to get involved in this. And then also for, if I failed to mention that for commercial enterprises, the loan amount is going to be limited to 4 times your earnings before interest, taxes, and depreciation, not to exceed $35 million.
Thank you so much, Larry. Absolutely. It's out there. It's some great access to funds if for some reason. This is really for the folks that are maybe not having a great situation with normal commercial bank. The LIBOR plus 3 is a little bit more attractive than some rates that are out there. And of course, government secured makes it a little bit easier for the bank to be able to say, you know what, I'm willing to do this. And then it's going to go direct to the Fed. So Larry, thank you so much. Over the course of this season, we have put together a great series of blueprints and the relief consulting toolkit. We couldn't actually fit all the ones on the screen here for the blueprints, but if you don't have a copy of this, for everything from FFCRA to the Paycheck Protection Program and a lot of different things in between, the credits, etc., we have some great blueprints out there. Please make sure to ask for a copy of that toolkit from your CPA. And I do want to just stress one more time, one of these we have a series around is the Families First Coronavirus Response Act, because as I'm talking to some clients, a lot of us as we're speaking, this post and promote concept is really significant. A lot of folks are testing positive because so many tests are being given now around COVID, and that all of a sudden puts somebody in a spot where they really are eligible for and need to receive the paid leave under the EPSLA. And so this post and promote strategy is one. Keep in mind, when you pay someone the emergency paid sick leave because they've tested positive or fall into any one of 6 categories, they're at 2/3 pay in the bottom 3, they're at full pay in the top. This is a dollar-for-dollar credit plus the health insurance expenses associated with it. And this is pure profit for an organization that goes directly to the bottom line. And so for a lot of folks, this can be a really material number. And so it's important to understand that if you're eligible for the credits around FFCRA, both the EPSLA as well as the Emergency Family Medical Leave Expansion Act, make sure that you are talking about this, make sure you're educating your employees and having generous application, and then most importantly, processing those credits that run through your payroll process. So just want to stress that one more time. I've been surprised at how many folks are not familiar with this or are not participating in it, because this becomes straight dollars to your bottom line and profits that are out there that need to be taken advantage of. And so as we've been digging through this, what matters most, what matters even more today. A lot of today has been around the PPP and capitalization, but that ends up all being straight dollars to margin. And so as we think about what deploying to margin means, and you look to what lies ahead, what's going to happen? We don't know. Are there going to be, just found out this morning, Texas is rolling back their reopening plan. A lot of other states have been doing the same. We don't know what's going to transpire in the future, but the same decisions that we were talking about 2 and 3 months ago are really the same things that all good business owners should be doing on a day-to-day basis. That is the sustainable path to success. Making decisions around staffing, around making margin positive decisions that put dollars to the bottom line, whether it's FFCRA credits, making appropriate decisions around staffing, rewarding performers. These are the things that we need to be doing as business owners day in and day out in order to not only sustain, but then to sustain success on the back end as well. So some of these things that are important, normal cost accounting, sound management, strategic planning, all these are things that need to be a part of your normal everyday process. That's what we talk about when what matters most. Tax planning, some today spin around that. These are decisions that put profits to the bottom line, and it's out there to be taken advantage of. It's just like the PPP loan. There's not many reasons why you wouldn't take it. Take full advantage of the things that are out there. Credit opportunities, not just FFCRA, but things like R&D credits, the work opportunity tax credit, local credits across all the different states that are out there. Make sure that we're taking the time to have these conversations with your CPA. We talk about the best deduction is a deduction we pay ourselves. Retirement planning is always sound. Good planning around asset acquisitions and depreciation, especially when you're in the highest income tax brackets. All these things are just part of the day-to-day, and they're more important now than ever because capital preservation through this season, especially in light of just the depth that a lot of folks I think don't realize of unemployment and of business activity and GDP degradation over the last couple months, it is really significant. And then I just want to put a plug in here for Estate and Gift Matters. Who knows what's going to happen this year? It's an election year. We have some of the most liberal estate and gift laws, well, not some of, the most liberal estate and gift laws in the history of our country. You need to start planning for this and thinking about if there are concerns around a potential rollback of these liberal estate and gift, especially for those with large taxable estates. Very important to go ahead and get some plans together of what actions might need to be taken, because if you wait, for instance, House, Senate, presidential offices change potentially, find yourself in a situation where these very liberal laws get rolled back. Having that conversation with your lawyer at the end of November is probably not going to result in any finished documents. And so what I really want to do is encourage people to get ahead of that wave and be thinking about it and go ahead and come up with a good plan regardless, especially if you're getting up against taxable estate. And then putting in good gifting hygiene on a day-to-day basis is always important. Want to make sure you're thinking about that day in and day out. So in closing, with the PPP, pick your right period. If you don't document it, you don't get credit for it. and which is to say, if those things are not in your file, all that support documentation, etc., it didn't actually happen. And so it's really important that we make sure that that documentation is in the file as we go through the PPP loan forgiveness process, especially for the over 2 million, but for all. You know you're going to get looked at if you're over 2 million, but everybody else as well. Long list of documentation requirements. Want to make sure that you take care of that and retain it appropriately. We look forward to helping all of our clients work through this, and already have a process out there. Looking forward to partnering and helping getting these things filed. Don't forget about everything else that's out there. Please take some time to look at the previous materials. Some extensive information on the website, specifically designed to help you focus on what matters most, with a realization that doing those things that matter most matter even more today. So I just want to say thank you to our wonderful clients. That's what we are here to do, is to serve clients. We thank you so much for that opportunity. And then I want to say thank you to our team, not only the folks like Larry, who's just carried the mantle and the baton through this season for us, along with so many of our other team members that have leaned in. I couldn't even begin to list them. I would be in trouble for not listing them all. And at the core of it, all of our team members that are day-to-day serving you, serving our clients so well. I just want to say thank you for this opportunity, and thank you to our team for doing such a phenomenal job serving through this season. We look forward to things opening back up, being full steam ahead. We are right now. We have a July 15th deadline. There are tax returns everywhere right now. This is like the busy season that just will not end. Started on January 1st. Here we are, and it is still going. So thank you for the opportunity to serve you. We thank you. And with that, I'll close us out. Feel free to put some questions in the chat. We'll focus on that for a couple minutes, but thank you for your time. Lord, we just bless you and thank you, Lord, for all the wonderful blessings that you've given us. Thank you for the opportunity to be of service in your kingdom. Help us continue to look for opportunities to give back, to encourage others, to lift each other up during this time. And Lord, we just pray for continued protection for this country, for our clients, for our people, for our families, and that you would carry us into this next season well, with a renewed focus on you. In your name we pray, amen. Thank you, everybody. I hope you have a great afternoon. Thank you for the opportunity to serve. Take care.